Why saving isn't enough in 2025. Investing isn't just a way to grow wealth, it's an essential tool to preserve your money's purchasing power against the ever-increasing cost of living. While saving money in a bank account might seem like a safe bet, it can be a losing strategy in the long run, especially in the face of inflation. As we step into 2025, inflation rates are still significant, and your money will likely lose value if left idle in savings accounts with low interest rates. Simply put, saving is no longer enough to keep up with rising costs. Investing is crucial to growing your wealth and protecting your future financial stability. Expert insight. Think of money in a savings account as a sponge in a flood. Over time, inflation erodes its value, slowly soaking up its purchasing power. When you invest, on the other hand, you're putting your money into opportunities that grow over time, just as a well-tended plant thrives with the right conditions. For instance, if you have $1,000 today, a savings account might give you 1% return annually, but inflation could easily be around 3%, meaning your $1,000 might only buy $970 worth of goods in a year. In contrast, investing in stocks or ETFs, exchange-traded funds, typically yields higher returns, helping you combat inflation and grow your wealth. Why investing is more effective than saving? It's common for new investors to wonder, why can't I just save money and let it grow? The simple truth is that saving alone won't build wealth in today's world. While it's important to save, investing provides the opportunity for your money to work for you, growing exponentially rather than simply sitting idle. Expert analysis. At its core, investing is a way to harness the power of compound interest, a force that Albert Einstein called the eighth wonder of the world. Compound interest means that not only do you earn money on your original investment, but you also earn money on the interest that money has accrued over time. Over decades, this compounding effect leads to exponential growth, making early and consistent investing one of the most powerful wealth-building strategies available. Example of compound interest. Let's break it down with a simple example. If you start by investing $1,000 a month at a 10% annual return, after 6 years, you could easily hit $100,000. But here's the kicker, the next $100,000 will come even faster, less than 4 years, then less than 3 years, and so on. By the time you reach a $1 million portfolio, you'll be seeing $100,000 added every year, simply by letting your investments grow. What should beginners invest in? Many beginners get drawn into the excitement of hot stocks, following trends, or investing in companies that have seen significant gains recently. The problem is that past performance isn't a reliable predictor of future success. Just look at BlackBerry and Kodak, once pioneers in tech. Their stock prices skyrocketed, only to crash years later. So, how can you avoid falling into this trap? The answer lies in diversification, a strategy that reduces risk and increases potential for long-term growth. Index funds and ETFs are two of the best options for beginners. An index fund is a collection of stocks, typically representing an entire market segment, such as the S&P 500. By investing in an index fund, you're effectively buying a piece of a large number of companies, which lowers the risk of putting all your eggs in one basket. Warren Buffett, one of the most successful investors in history, has long recommended index funds as the best investment for most people. Why? Because they are simple, low cost, and provide broad market exposure. Instead of focusing on individual stocks and trying to predict winners, you're investing in the market as a whole, which has historically trended upwards over time. Consider the S&P 500 ETF. By investing in this ETF, you gain exposure to 500 of the largest U.S. companies, including tech giants like Apple, Microsoft, and Tesla. Rather than trying to pick the next big winner, you're betting on the overall growth of the American economy, which has consistently outperformed other forms of investment. When and how much to invest? One of the most common questions I get is, when is the right time to start investing? While there is no perfect answer, there are key steps you can take to ensure you're financially ready to invest. Before jumping into the stock market, make sure you've checked off two crucial financial steps. 1. Pay off high-interest debt. If you have debt with interest rates above 7 to 10%, such as credit card debt, pay it off first. The reason is simple: paying off debt at these high rates is essentially earning a guaranteed return. If you're paying 20% interest on your credit card, that's a return you can't get anywhere else. 2. Build an emergency fund. Having an emergency fund of 3 to 6 months worth of living expenses is a financial safety net. Without it, you might have to dip into your investments during a market downturn, locking in losses. An emergency fund ensures you can weather unexpected financial setbacks without needing to sell your investments at a loss. Let's say you have $10,000 in credit card debt at a 25% interest rate. By using that $10,000 to pay off the debt, you're essentially earning a 25% return, because you're saving yourself from paying $2,500 annually in interest. In contrast, investing $10,000 in the stock market at a 10% annual return will only earn you $1,000 a year. Therefore, paying off debt is often the best return you can get in the short term. How to buy your first stock or ETF. Once you've paid off debt and built your emergency fund, the next step is to start investing. Opening a brokerage account is the first step in this process. You'll need to decide whether to use a tax-advantaged account like a Roth IRA or a traditional brokerage account. For long-term investors, a Roth IRA can be a great choice because of its tax benefits. Your investment grows tax-free, and you can withdraw the funds in retirement without paying taxes. However, if you need flexibility, a taxable brokerage account might be a better fit, as it allows you to access your money anytime. Let's say you decide to buy shares in an ETF like the S&P 500 ETF, SPY. You can easily purchase shares directly through a brokerage account. For beginners, it's a good idea to start with ETFs because they give you exposure to a broad range of companies, providing built-in diversification. Long-term investment strategies and how to handle market fluctuations. Market fluctuations can be nerve-wracking, especially for beginners. It's tempting to sell when the market drops, but panic selling is a common mistake. The key to successful investing is patience and long-term thinking. Historically, the stock market has trended upwards despite short-term volatility. For example, during the 2008 financial crisis, the market took a massive hit. However, those who held onto their investments eventually saw their portfolios recover and grow significantly. This is why it's critical to invest for the long term. If you can hold through the ups and downs, your investment will likely grow over time. Look at the performance of the S&P 500 ETF, SPY, during the 2008 financial crisis. If you had bought into SPY in 2007 and sold during the crash, you would have lost a significant amount of money. But if you held onto your investment, it eventually recovered, and by 2018, you would have doubled your money. Long-term patience is key, and history shows that those who hold onto their investments, even through market downturns, are typically rewarded. Why 2025 is the year to start investing? 2025 is the perfect time to start your investment journey. With the right strategies, even small investments can grow significantly over time. The key to success is staying patient, sticking to long-term strategies, and avoiding emotional decisions during market fluctuations. Investing is a marathon, not a sprint. While it may seem daunting at first, taking small, consistent steps will eventually pay off. By focusing on broad market indices like the S&P 500 and avoiding the temptation to time the market, you'll set yourself up for long-term financial success. Even if you can only invest a small amount each month, over the years, these small investments will compound, creating a much larger portfolio than you would have had if you had waited until you had more money to invest.